Hi, and welcome to my regular weekly Property Insiders chat with Dr. Andrew Wilson. Apart from giving you an update on all the property market data, we're going to talk about some of the latest labour data, some good news about Australia's economy, and we're going to discuss a forecast by a major world rating agency, Fitch Rating, on what they think is going to happen to Australia's property markets moving forward. If you want to keep up to date with property, please subscribe to this YouTube channel and click the little bell icon so that YouTube updates you each week when we bring out our latest video. It wasn't that long ago that we were officially advised Australia's in recession. But some people are wondering, is it already over? With spending increasing, more jobs being created, home buyers borrowing again. Of course, the third quarter of 2020 finishes at the end of this month, so we won't really officially know whether we've had another quarter of negative GDP for some time. And yes, there is still plenty of bad news out there, and there's more to come. But there's also lots of good news if you look for it. Interestingly, many of the property pessimists who predicted real estate Armageddon only a few months ago now seem to be backpedaling. At the time of the first lockdown in March this year, the Chicken Littles hit the streets, the airwaves, the internet, declaring the world as we know it come to an end. Remember the Chicken Little and Henny Penny? Chicken Little thought the sky was falling, but he was wrong. A bit like the property Chicken Littles. Yeah, it's true that there was a bleak outlook back then. Some say there still is a bit of a bleak outlook. The problem is fear is a very powerful emotion, and one that these people, these Chicken Littles, used to grab media attention. Unfortunately, these Chicken Littles did nothing but cause chaos, deflate financial dreams of fellow Australians, all for the sake of a little publicity. You see, when we look back at the property predictions made earlier this year by some of the high-profile economists, as well as the usual tribe of property naysayers attempting to exploit the pandemic for publicity, you'll find they were consistently wrong. Well, in today's weekly chat with Dr. Andrew Wilson, Australia's leading housing economist, I'd like to discuss a new bad news forecast for Australian property by an international rating agency, Fitch Rating. Let's see what he thinks about their thoughts and if they're going to be wrong as well. I also expect Dr. Wilson to update us with the latest property data and give us some good news about economic information. So welcome, Andrew.
Yes, thank you very much, Michael. And I am very impressed by your Chicken Little analogy.
Brings back memories, doesn't it?
Yes, it does. And well, at least there's some consistency there. And I think we can doff our hats to those forecasters that, yes, they're consistent and they're consistently wrong. And they're proving that again this year, as we found out again last year. So there's some consistency there in their forecasting capacity, which is quite low at the moment.
We'll get into that in a moment, but let's first start with what happened to the property markets in the last week. Let's have a look at the data, and then we'll have a look at some forecasts.
Well, yes, Michael, let's have a look at the week that was last week in the housing market and some highlights from the latest economic data. So firstly, as usual, we look at the weekend auction markets. There were some interesting results, Michael. We're certainly seeing auction activity increase or strengthen, really very typical of what we do see as September evolves in our auction markets. Of course, the spring selling season, listing numbers are rising, clearance rates are rising, and it's all part of that spring vibe that does activate most of our capital city markets. Sydney market is a standout in terms of higher volumes and clearance rates now moving over 70%, Michael. That 70% benchmark really does reflect increased pressure on prices, really moving into a seller's market in Sydney. Other smaller markets, Brisbane, Adelaide and Canberra, also showing signs of increased auction activity, higher listing numbers generally, and quite solid to strong clearance rates. Canberra has been a standout during the post-pandemic shutdown period. Of course, we do have an outlier in all this positivity, and that's the Melbourne market. Again, really, the auction market in Melbourne disappeared on the weekend. Just 12 properties listed for sale. There's no point in producing a clearance rate with these numbers. They don't really give us any insight into what's happening broadly in the Melbourne market, other than the fact that we can't conduct open air auctions or open for inspections. So that's really pressed the pause button in the Melbourne market. And we, of course, await the reopening of the Melbourne economy post the significant shutdown policies at the moment. And then we'll see that market pick up again, as we have seen with the other markets when they've come out of lockdown over autumn. I think that's a good positive sign for Melbourne's prospects going forward, that markets do pick up quite quickly, and I expect the Melbourne market to do so. Sydney market, we're starting to see some 80% clearance rates in the regions. Inner West, very strong market results on the weekend. Not only the highest number of results, but also clearance rate over 80%. So certainly a very positive result there for the Inner West, but most other regions are recording clearance rates over 70%. As I said, certainly reflecting an emerging sellers market in those regions in Sydney. We can see how consistent those clearance rates have been for Sydney, and now an upward trend emerging. Melbourne auctions, and as we discussed, this has been an exercise in auctions disappearing. We can see auctions in Melbourne since the beginning of August compared to the same period last year, and they're well below. So really the Melbourne housing market is a non-event at the moment. It is in hibernation, and we await the opening up for the revival of that market. New listings we look at every week, Michael. New National New Listings Index, it's starting to show some signs of increasing, still below its base point at the beginning of the year through autumn. But even with the Melbourne shutdown in activity, new listings are on the rise, and it's certainly at least been quite consistent going forward. And I think this is a good sign, given the fact that obviously new listings are very low in Melbourne. And we can compare that with last year's at the same time. Michael, we're actually getting a little closer to the same period last year, early spring, in terms of new listing numbers. Of course, that was a significant market revival last year through spring, and listings were starting to rise as sellers became more confident. But we're starting to see that match again. So some more positive signs for the general market in terms of seller sentiment. We can see that new listings increased in Sydney by 2%. Melbourne new listings were actually up over the week. So there's still activity occurring in Melbourne, but of course it is coming from a low base. And when we look at the new listings over the past week compared to Sydney as a base model, we can see that Melbourne is well below the volume of new listings in Sydney. 60% fewer new listings coming through last week compared to Sydney. The other markets are roughly tracking where you'd expect them to on their population differentials. Now let's look at newly reported sales, which we also track, Michael, as you know. And we can see now new sales are actually rising in Sydney over the past week. That index is showing some consistency in terms of growth, and its numbers are now starting to track around about the autumn peak. So once again, a normalisation of the market through spring. And if we look at Melbourne, no surprise, of course, we're seeing sales move in the opposite direction. And we would expect to see fewer sales than growth in the index than listings, and we'll see that in a minute. But certainly new sales are falling. These are newly reported sales in Melbourne. Brisbane moving quite strongly now, the Brisbane market in terms of new sales. Brisbane, Michael, as you know, tends to be a second half of the year market. Really, it has I guess, a summer-winter type feel to it, or first half, second half type of feel to it, the Brisbane market. But up and about with new sales clearly on the rise in Brisbane. We can see new sales up in Sydney by 8.5% over the week, down in Melbourne by 9.5%. We shouldn't be surprised at that, because listings are one thing, but sales are certainly another in terms of commitment in the property transaction process. And when we look at the relative position of newly reported sales over the week, we remember that new listings in Melbourne were around about 60% down on Sydney in terms of volume over the past week, but new sales are 80% down on Sydney. And I think that's fairly predictable, Michael. But as we said, hopefully this is the trough of the market in terms of the shutdown restrictions in Melbourne. Certainly the news is getting better in terms of the prospect for opening up the market, and that'll certainly revive buyer and seller activity, particularly buyer activity going forward. So we can have a quick look at the economic highlights over the past week, Michael, and really just starting off with what we usually look at, and that's the share market. Eased a little bit last week, the share market, Michael, despite those better than expected unemployment numbers, but still tracking quite consistently above its trough period during the lockdown period in autumn, the lockdown phase in autumn. Australian dollar continues to rise quite strongly. We are starting to see iron ore prices come down, Michael, and that'll have put downward pressure on the Australian dollar, but certainly still very strong in terms of the last year or so. And again, a reinforcement that international investors are prepared to back the Australian dollar. Of course, as we've said, that there is some weakness in the US dollar as well, pushing that Australian dollar upwards. But I think overall it does show some confidence from international investment investors in the prospects of the Australian economy. But the big news last week, of course, Michael, as you know, was surprise, perhaps sharp fall in the unemployment rate, fell below 7%. Is this a downward trend? Next month's numbers will be interesting, of course, because they will cover more about what's happened in Victoria during the shutdown period, but certainly some surprisingly good news in terms of the unemployment rate. No sign of some of those 30% unemployment rate predictions, Michael. We might not even get to 10% this year, which will really shock a number of those doom and gloom pundits. If we look, however, at the underlying data, I think that's quite interesting. We can see that since the end of the lockdown in May nationally, that we've seen a strong recovery in the number of jobs that have been created, Michael, in that period, still rising over 100,000 new jobs created in August again. And those returning to the workforce also numbers still remain quite strong, lower than in recent months over August, Michael, but still nearly 25,000 people returned to the workforce. That is, that they became more confident that they could find work. And overall, since the end of the shutdown, Michael, we've had nearly 500,000 jobs created and nearly 500,000 workers are returning to the actual workforce. So, in fact, if we had have taken that return to the workforce by those 25,000 people, growing the workforce by that number, Michael, over August, it actually would have had the unemployment rate even lower if we had have had the same participation rate as we did in July. So even though we're still nowhere near back to where we were, Michael, the trends are very, very positive at the moment. And if we look at the capital city performances, we can see that all capital cities, with the exception of Victoria, where we saw, a marginal increase in unemployment rate up to 7.1%. Unemployment rates moved downwards in those states over the month, with New South Wales and Canberra the clear leaders.
So, Andrew, if you dug deeper into the employment data, were there any trends that you were able to notice?
I think one of the interesting things that's being reported, Michael, is an increase in the female participation or jobs growth in the female workforce. Also, of course, part-time jobs are quite strong at the moment. So these trends will emerge as we enter into the significant post-coronavirus shutdown period. But no, it's unequivocally positive data there, not just for housing markets, but also for the economy moving forward.
Well, at the beginning of the year, when all this started, people weren't sure what's ahead. And as we said, there were some pretty dire forecasts and they haven't really come to fruition. But this week I was surprised that one of the world's major credit agencies, Fitch Ratings, suggested that Australian house prices are still going to decline 5 to 10% over the next 12 to 18 months. And they in particular blamed immigration weakness as a cause for this. Now, we know that immigration has slowed down and in fact has almost halted. But if we look back at their track record, they made some predictions at the beginning of 2019. How did their forecasts then pan out?
Fitch Ratings, who are an important part of the the financial modelling for our economy, particularly in terms of credit securitisation. So they do produce forecasts. They were one of many who got it wrong last year. They predicted significant falls, particularly in Melbourne and Sydney. They also predicted that on the basis of their GDP forecasts, which were also wrong last year. This year, as you mentioned, Michael, they are predicting a sharp decline in house prices next year. Their basis for their analysis is, which we know will be accurate, and that's a sharp decline in migration levels. What they've done is they've basically transferred the base of household formation levels through lower net migration and the levels of new construction, put those together for their forecast. This is old-fashioned forecasting, Michael, measuring, broadly supply and demand with those insights. There are many more factors to be considered when we look at the forecasting of house prices based on those basic household formation new dwelling numbers. Even though we will see a less household formation, not just through migration, but also perhaps through younger people staying at home longer, the real issue forecasting and household formation and price sales and transactions is the internal housing market and changeover buyers particularly. We saw very strong activity from local changeover buyer activity last year, Michael, particularly in Melbourne and Sydney. Even though we had sharp declines in net migration, we had very strong prices growth over the second part of the year, which again reinforced that local market dynamics, notwithstanding household formation rates and new supply levels, really are the major factors in terms of how house prices move. And of course, interest rates and the economy generally are factors that determine what local changeover buyers do. And we've got to understand also that investor numbers have been very low as well last year. So despite lower numbers of investors, despite lower numbers of net migration and household formation, we still saw very strong prices growth last year. Again, I think that we'll find that those predictions of sharp declines in house prices, I think, will be challenged sooner rather than later. And look, we're seeing other forecasts. Westpac have turned, of course, their recent predictions as well, Michael. They were predicting sharp declines. They've backtracked again this year with other banks as well. And they're now actually predicting strong prices growth at the end of next year. I'm not sure we're going to see strong prices growth, Michael. I think our prices growth prospects, given where interest rates are going to be quite modest as our cycle has really run out of puff. And I think that's one of the reasons why we've seen such a flat response to the shutdown period, is because basically our cycles have now flattened out, and going forward, the negative and the positives will produce lower outcomes.
Well, as you say, Westpac have increased their forecasts upwards, so has Commonwealth Bank and a number of other forecasters. The banks actually have a huge database. They can see which loans are being taken out. They can see how much of their book is in default. They can currently see that people who took mortgage holidays are starting to now repay them. So I have more faith in the bank's forecasts because they see what we're spending. They see what we're using with our credit cards. So there is some good news out there.
Well, the question is, Michael, given how much skin in the game our major banks have, and the fact that they have very strong market power, why do they keep getting housing market forecasts so wrong? And as you said at the beginning, Michael, ignore some of the headline chasers with their forecasts, their hysterical and usually wrong forecasts. That is just about a cheap grab for a headline. But when it comes to very important players in our financial sector and our economy, such as Fitch Ratings and our banks, there should be a lot better performance from them, I believe, given the ramifications that those forecasts can have on consumer sentiment, not just in the housing market, but in the broader economy.
Of course, each week we remind people that those very broad-based forecasts are fraught with failure because there isn't one Australian housing market. There isn't one Sydney market. So when they say Brisbane's going to go up 20% over the next couple of years, what about apartments? Are they different to houses? Yes. Are they different to townhouses, the inner suburbs, the outer suburbs? So that's one of the other challenges as well. Well, once again, we've got a better insight into where we're heading, Andrew. Thank you very much. Look forward to catching up with you again next week.
Yes, Michael, thanks very much.